Back there, staying with that report from the CPPE, Dr. Muda Yusuf in that report was overly optimistic about revenue and projections, and he says this might affect the economy moving forward. Projections that we have historically weakened the budget implementation and its credibility. That's according to Dr. Yusuf. He also referenced geopolitical developments, including tensions involving Venezuela, noting that while such issues could influence global oil markets, their immediate impact may be limited. Well, on tax reforms, the report acknowledged that while recent controversies appear to be easing, he warned that implementation must be handled with care to avoid unsettling the economy. Addressing concerns over jobless growth, the CPPE chief argued that strong GDP figures alone do not guarantee improved welfare, stressing that employment generations depend largely on investment and productivity. My next guest, I introduced him earlier, is Mr. Ugodre Obi-Chukwu. He's the Chief Executive Officer of Nairametrics. Thank you so much, and Happy New Year to you. It's really good to have you on the program.
Always a pleasure, man. Happy New Year. How are you?
I'm very well, but I could be better if inflation could go as less as 10%. But really, we are going to see that push in December, and you agree with me, as we move into January before the MPC meeting in February. Just let me allow you give us an overview of what you think of our economy in 2026, considering where we stopped in 2025.
You know, I always say one of the worst times to maybe give an economic outlook is the first week in January, because we're all just coming from dirty December, so we're still dirty.
We're still dirty, yeah.
So, yes. So, but I mean, all the same, it's been interesting hearing and reading several reports from different brilliant research houses on the outlook for 2026. I think. I mean, most of what you would expect is it's a year or two halves. Expect to see in the first half of the year, companies, government, everyone essentially ramping up activities because as you get into the second half of the year, we now start to get into what we all call election mode because at that point, most government businesses are gearing up for the 2027 election. But most government agencies, government apparatus in general, are gearing up for 2027 elections, including the states. And even though historically there really isn't that much negative correlation between election activities and the overall macros, it does usually affect policy implementation, or at least the pace of policy implementation, and then even decision making by a lot of organizations. So I do expect, in terms of macros, inflation numbers, I expect it to dip. We could hit single digits at some point this year. But in terms of when we exit, when I say exit, end of the year, we could be at the double-digit side, probably around 12-13%. I think we could also average around that by the end of the year. Interesting that the CBN, I think, it's also projecting 12.9 or 12.8% in terms of their average inflation for 2026, which I do agree with. Totally, in terms of exchange rate, I think last time we spoke, I'd said that, I think it was early last year as well. One of the first times we spoke last year, I expected inflation exchange rate to strengthen, and I think that within the 1,350, 1,450 band, we could see the exchange rate average around that. There's a lot of bull case for that. There could also be downside. There are other things that could push exchange rate below the 1.5 level. When I say below the 1.5 level, the negative, that's 1.5, 1.6, and all of that. Particularly maybe things that are really outside of our control as Nigerians. Could be, crude oil prices. It could be some geopolitical related issues that could impact exchange. But other than that, I think the way our exchange rate market operates now, it's more market driven. And so a lot of what you see, sort of, even some of these these headwinds that would think might happen, sometimes are you have counterweights in the economy now. So for example, if you have weaker exchange rate, then that can be complemented with lower fuel prices. So just because we now have a more market-driven economy, so things are a lot more balanced. In terms of GDP growth rate, I think I do agree with the previous lady you interviewed. No way do I see GDP hitting 5%, which is really what we need, and that's because of the way our economy is structured. For us to be at that 5% GDP level, still you're going to need government to spend. You're also going to need private credit to expand. And I do not see how we're able to ramp up capex and private credit in the first half of this year. And so I think you're probably going to see slightly above 4% GDP. That's what I expect. If we see anything more than that, embrace it by all means. But I don't think GDP will be one of those big stories we see this year in Nigeria. So, I mean, for me, there are other concerns. There are concerns around 2026 budget, concerns around fiscal deficits, and the government's planned borrowing is a bit of a concern. Concerns around taxes. I think government rely a lot on taxes this year. So you're going to see a lot of aggressive taxation this year as one of those means for government to at least show up as revenue. And then I think all eyes should be on states, and states are awash with a lot of cash. So we're tracking budgets for states as well, particularly capex budget for a lot of states and how well they are able to implement. So in a nutshell, that is sort of like my own outlook on the macros, Tolu.
Well, let's stay with the banking sector. Let's start with the financial space now and the recapitalization exercise. And of course, I think many of the top banks, they are meeting up so easily. I'm asking this in relation to the stability and the strength of our banking system. What are you learning in regards to that?
I mean, I think a lot of people were surprised when the central bank had moved for the recapitalization 2 years ago. And I think people maybe sometimes underestimate the resilience of the Nigerian banking system or the people who maybe control the banking system. And so when they did ask for this recapitalization, I guess maybe the central bank knew something that we did not, which is that they had the capacity to meet the recapitalization targets. And here we are a few months away, and I think 95 or so percent of the banks have met their targets, and within good time as well. So that speaks to the confidence that it appears investors have on the banking system, and as well as what confidence investors also have on the management of some of our banks. Now there are concerns around write-offs. I think that you're likely going to see a lot of when a lot of these banks release their numbers this year, you're likely going to see loan impairments surge across the banking sector because what it's essentially happening is banks now have capital, so probably the best time for them to clean up their balance sheets ahead of what will be a very competitive next 5-year cycle for a lot of banks. And so, we just went through one phase. The first phase is to raise this capital. The second phase is competition. And I think that this competition could end up being a zero-sum game. You're going to have banks that might have to be swallowed at some point if they don't compete well. So in terms of my outlook for banks, I think this year, as the results pour in, you're going to see banks struggle with loan impairment. Some of them would have them written up. That could affect their bottom line. But at the same time, banks are very well capitalized now to drive the so-called $1 trillion economy that we're all looking for. Even though I do not expect lending to be as aggressive as some of us would prefer, I think banks will still be a little bit coy with how they lend. And of course, Tolu, at the end of the day, we always say we want banks to lend, but where are the businesses? So you see banks tend to lend, putting a lot of money in oil and gas. They've been burnt a lot. So I don't think this is where a lot of them are looking at or should be looking at. You probably will be looking at very good infrastructure related funding, provided that it is well packaged and de-risked for banks. And you could see a lot of inroads for banks in that direction. But as a sector, I also expect banks to continue to grow, maybe not at the aggressive double digit that they've been doing in the last 2-3 years, aided of course by devaluation. But banking sector will continue to grow. Now, one other sector that you should also pay attention to is the insurance sector. I think a lot of what happened to banks in the last 2 years positively. I think you want to see that. You should expect to see that happening in the insurance sector, backed, of course, by the NAIRA Act. So interesting year for the financial services too.
I totally agree with you. Back to revenue issues before I go to my next one. That just came to my mind, your first submission, talking about the aggressive move of government in taxation, of course, and expectations of revenue generation for government. The non-oil space, for me, is still somewhere we really need to better explore. Now, what is happening in Venezuela, the United States taking over oil and all of that, that might impact oil prices negatively or positively. If that happens, our budget projection is about $64. What options do we have for revenue, really, in your thoughts?
That's why I was very concerned with the budget, particularly with some of the underlying assumptions, even though I think more than ever we've seen, at least compared to the last few years, we've seen budget assumptions that mirror that's a little bit realistic. Yes, you're right. Crude oil price benchmark at 65 or so dollars per barrel. Let's also remember that Nigeria's main exports, crude oil, is usually the price is usually higher than Brent. So it's usually about, sometimes the spread can be even as high as $10 higher than Brent. But we're budgeting $64.8, and so we're looking at crude oil production output 1.8 million barrels per day, exchange rate 1.5. So, but when you compare this to what we did last year, you see that last year's budget, in terms of oil revenue, seriously underperformed, and so this year I expect that focus will be on non-oil revenue as a major driver of government's revenue receipts this year. Oil will still play a major role, but I think a lot of emphasis will be on non-oil revenue, which both of us know is in corporate income taxes and VAT and custom duties as well. That is where I think government does see as a low-hanging fruit, and why you're seeing a lot of publicity around taxes. Make no mistakes about it. These things are not just happening accidentally. There is a coordinated design to ensure that taxes is in the top of mind of every single person. I think they've pretty much achieved that already, because they know that is probably where you're going to see a lot of emphasis. I also expect that there might be some asset sale, mega asset sales this year. If not this year, you could see the start of government also exiting some of its assets, perhaps listing some of them on the stock exchange, as one of the revenue drivers. Government still holds significant assets in a lot of entities that, to be honest, they probably should be unlocking revenues from. So I think that's probably going to be those areas that you would see. This, of course, depends on what's happening globally. Yes. We've seen what's happening in Venezuela, but there's one thing that last year taught us, is that it kind of looks like market seems to have fragmented seriously. So whilst there are geopolitical events that are going on that in prior times will impact markets, market seems to be slightly muted, and then even if it does affect market, they seem to pick up quite quickly. Remember, when Trump announced those mega tariffs early last year, everyone thought that's it. The global economy will unravel. That didn't happen. Remember when they also dropped bombs on Iran? There was also a fear that could, maybe unravel. It did not. So I do think that it's also in the best interest of Trump and his allies that oil prices don't also come down too low. because of their own cost of production. So for me, I think that we might not be able to meet this average $64.8 in terms of a crude oil benchmark. We're probably going to be seeing an average of 58, 59, around that range. So based on that, I would not think that oil revenue will be one of the key drivers for government spending this year. It's likely to be taxes and borrowing, which is why I had said that I was a little worried. I think the government 20 trillion or so of fiscal deficit with 17 trillion of borrowing. So that essentially could crowd out the private sector. Imagine hitting the economy with 17 trillion of new borrowing this year. I think 4 or 5 trillion of that is external, while the rest is local. So that's where I'm a little worried. But in terms of revenue, it's likely going to be taxes and sale of government assets.
Then again, and almost finally to interest rate and other issues. The manufacturers have continued to complain. Even recently, they still came up with a write-up that they need to get funds at better rates. And other players in the real sector talked about interest rates being on the high side. Now, the first meeting would be in February. And just like my guest earlier said, December inflation, we might see a spike. And when at the end of January, before that meeting in February, maybe we start to see that decline. But I'm just thinking loud. What do you think will be the concerns at that meeting? And are you expecting any shifts in February?
There better be a shift in February.
There has to be a shift, honestly.
I expected a shift in
November. I think November, right?
But I understood why that shift didn't happen, even though on the headline number it didn't happen. But in terms of the rate at which the CBN lends money to the bank and borrows from the bank, I think there were shifts there. So I think that when they meet in February, we should anticipate a rate cut, albeit very limited. We could be seeing maybe 25 basis points to 50 basis point rate cut. I anticipate larger rate cuts this year. In our podcast, which will be up, Drinks and Mics, on Friday, my colleagues think that rate cuts might probably be very, very conservative this year, to your dismay, because I know you want rate cuts as well. They think that rate cuts could be very, 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 very low this year. But to the manufacturers, I think that what is very clear is the central bank is focused on, macroeconomic stability. They do not want to rock the boat at all. They are not fooling themselves that, because you're seeing inflation numbers go down, and then we should aggressively start cutting rates. I think they also have one eye on the exchange rate as well and what impact that could have. Now, throw in the fiscal deficit that I mentioned earlier, that will give the CBN some concerns as well, because you're having a lot more borrowing coming into the market in a year where you expect interest rates to come down. So to the manufacturers, I kind of think this might not be that year where you see rates start to crash aggressively. I don't think it's going to happen. So best bet would probably be, to tap into other debt related markets, such as, I guess, commercial papers, commercial bonds. And you're seeing a lot of companies do that. I think there's a lot of room for equity-based capital. And I think that's really where a lot of companies should start to focus on. I think this focus on debt-driven capital probably something that they should consider less now. A lot of organizations need to raise capital. We have about 140 or so trillion in money supply. There's a lot of money out there. You've seen how much was raised last year by banks and by a lot of companies. And so I do expect to see, for a lot of the manufacturing companies, what you need is long-term capital. And Nigerian banks, even with the capital that they've raised, are not equipped to give you 10-year loans. And so if you're a manufacturing concern and you're looking for 2-3 year loan, you're actually not in business. So the sort of funding they should be looking for are equity-based funding. Now, I do also want to mention that we also need infrastructure type funding, and I think that is a special kind of funding on its own, where providers of this debt know from the get-go that these are long-term related debts, either structured for manufacturing or for infrastructure-based projects that have pure, clear economic impact on our GDP. But of course, not doing this the way it was done during the Emefiele years of Ways and Means. This is maybe through some government vehicle or through some private sector PPP vehicle backed by some foreign institution. But other than that, hoping that banks are going to be the one to drive manufacturing growth through cheaper interest rates, I think is probably foolhardy at this point in time. What we should expect is more of them tapping into other conventional debt markets and raising equity as well. In terms of the housing market as well, I think some of the initiatives of the government do help. The MREF and some of all these subsidized, even though they probably want to call it that, but subsidized interest rates for the real estate market is helpful, because these are some of the things that create jobs. Because the more houses that are being built, the more jobs are being created directly and indirectly. But for my overall interest rate outlook, I don't think you're going to see a favorable interest rate environment. And when I mean favorable, favorable is anything below 14%. If you're still at 16, 17, 18% interest rate, that's pretty much still high.
Well, it's a good way to live it. I must thank you so much for sparing time. I know you're a very busy man. Thank you so much, Mr.
I'm here for you.
And we're still expecting it. Thanks for the good work you do at Nairametrics, and a lot of collaboration this year as we move on. We should be able to do more. Thank you so much, man. Mr. Ugodre Obi-Chukwu is the Chief Executive Officer at Nairametrics. Do enjoy the rest of your day. Cheers.